Hello, Jim here. There's a fine line between being a profitable trader and being a safe trader. Today, I want to talk about 5 moves or strategy changes you can potentially make to make yourself both of those things. I'm also going to share with you at the end of the video my most recent changes to my planning worksheet and how it's helping me come up with these kind of moves or strategy changes that have made me a better trader. So stay tuned. I think you're going to really enjoy what I have for you. Okay, let's go ahead and jump right in. I do like to give a quick market update at the beginning of a lot of my videos. A couple weeks ago, I was thinking the Fed wasn't going to cut rates. I do believe they will cut rates next week, a quarter point. So that'll be a full percentage point that they've cut rates since, I can't remember when the first rate cut. I think it might have been in October. And the consensus is they'll do more next year. Some people are thinking 4. I'm thinking more like 2. A lot depends on what happens with the economy at that point. What's the impact of Trump's tariffs and, with the new administration, what kind of changes might occur. I do believe we're kind of in a mixed environment. We have higher inflation than we typically want. If you're like me, and every time I go to the grocery store, I'm shocked with some of the prices. And then on the flip side, I think unemployment is higher than what the government's reporting. I keep hearing about people who have lost their jobs or can't find jobs, even though it sounds like there's plenty of opportunities out there. So I think we have kind of a mixed bag in the economy, and I don't necessarily believe that'll be a bad thing for the market. I do think the market will probably have another good year. I'm not so sure it'll be as good as this year. But it'll still be very volatile, again, with the administration changes and a lot of the changes in the country that they're going to be making. Potentially will have higher volatility, which is really good for option traders like ourselves or just traders in general. I do think there'll be a flight to quality a bit more than what we had this year. There's been a lot of momentum plays this year. I think next year may be a little bit more of a flight to quality. So that being said, let's jump into the moves or strategies that have helped me become a much better trader. So first, and I've said this in many of my prior videos, is picking the right companies, and price does matter. So identifying a company that has good fundamentals, good return on equity, good return on assets, also good return on capital. For return on assets, I like to see it in the teens. For return on equity, above 20% is what I like to look at. Another big issue I had originally was not looking at debt enough. I made a lot of purchases probably back in 21, like Lumen Technologies, that had way too much debt. There were several instances where I should have avoided companies because I had way too much debt. I like debt to equity below 50%. Also like to see companies who are growing year over year. Earnings are growing. They also, are well run or well structured, meaning, they don't have a brand new CEO. They have a good management team, which is kind of one of those factors that's hard to quantify, but it definitely can make a big difference. Some of the companies that have taken a major hit have lost a CEO. One is like Path Technologies that I've also invested in, and I'm hoping they recover long term, but they let go of their CEO, and that had a pretty major impact. And I think Intel is another scenario like that where the management has caused issue, and that's one of those almost qualitative factors that's harder to quantify or identify, but it definitely does make a big difference. And then what you pay for the company. So it may be a great company, but price does matter. At some point, the stock price will return to the mean, meaning if it's way overpriced, it'll come down over time. At some point, it may stay in momentum for a long period of time, but long term, it will kind of come back to the mean. And the same thing, if a company miss earnings and it does a nosedive, it'll also come up and also get back to that mean, and that stock price will return to what's more accurate. It seems like the market is very reactive these days compared to what it was like back in 10 years ago. If they miss earnings or give poor guidance, the stock just is hammered. Or if they give just, good earnings or good guidance, it can go the other way. It can shoot through the roof. I've seen some companies, go up 40 or 50 points. APP, the App Loving company, is another one that just shot through the roof. And I noticed recently in the last couple of days, it's lost a lot of its value. It shot up from, I think, right around 100 to like 300. And now it's, I think, lost 60 or $70. So momentum is a wonderful thing. There's a lot of traders who make a lot of money with it, but you need to be careful because long term it will gravitate back to the mean. One great example is Cisco. Cisco was it was almost like the NVIDIA of now. And if you look at its numbers back around 99, it was actually worth more than NVIDIA is today. It was probably had the highest market cap of any company out there. But now it hasn't reached those highs in almost 15 or 20 years. So just something to keep in mind. One thing I've learned over the years is to use protective puts and calls. Long term, more so with puts, but recently looking at protective calls, especially when you have a company, excuse me, that's my dog shaking, especially if, recently when we've had a lot of companies shoot through the roof and have gotten quite expensive, they can have a pretty big impact. So I've been playing with the idea, and I've talked about this in other videos, of buying a call. So instead of doing a covered call, you're doing a covered call spread. And I'm actually looking at doing that on some of the stocks I was recently assigned. So just something to keep in mind. Now for the puts, the beauty of purchasing the long put is as that stock drops, that put becomes more valuable. So yes, you may spend a little bit more money on buying that put, but then if the stock drops pretty majorly while you have that position, that put will become worth more. And it gives you more choices for expiration or for managing that trade. You can potentially sell the put, allow the assignment, and then lower your cost basis. You can do potentially turn it into a cash secured put, meaning it's a vertical put credit spread. You could sell the put and then sell a future cash secured put and potentially bring the strike price down for that cash secured put. That's something else I've done. I did that with Dell and it's worked out quite well. I've been able to bring Dell, I believe I brought it down from like 135 to 125 and then to 115 or something along those lines. So it just gives you more choices. I've had other YouTubers or influencers talk about how vertical put credit spreads are bad and you shouldn't do them. And I completely disagree. If you're an investor first like myself and your main goal is to own a lot of these companies, then by buying that put and the stock drops significantly, it allows you to get in at a great price. So long term, you'd end up doing better. Of course, this all comes back to picking the right stock because your hope is that it'll rebound and it'll be worth a lot more than what you paid for it. But sometimes the opposite happens. Walgreens is a perfect example. It shot through it didn't shoot through the roof, but it did go up. And then I believe during the Biden administration with all this legal crime that they've instigated, the stores have been hit really bad or really hard. I know a lot of the stores have been closed and more are planning to be closed, especially in blue cities. And that's had a major impact. And Walgreens, instead of recovering, keeps halving its value. So it went from like 20 to 10. And I could see it going to 4 or 5 or being bought by maybe CVS or a different company. But just something to keep in mind. And then, that kind of leads itself to avoiding missed opportunities. One of my biggest mistakes was, again, I had the opportunity to own companies really cheap, but I rolled myself right out of that opportunity. Now, I have had some get assigned to me that have not worked out, but probably more have been where I've missed a great opportunity. So something to keep in mind. So I like to keep a history and I share it with my membership of why I've gotten into a stock and why I picked the strike. And it makes it easier to go back to that and to see the details on why I got in originally. Something to keep in mind. Now, if you're curious about my memberships, I have 3 levels. I have a coaching level. I have what I call my trader club level, which we have meetings every other week. We have one next Monday where we talk about different types of trades and how we want to trade. Those 2 memberships, you get access to the Discord, and the Discord's gotten pretty active. There's a good number of people sharing their trades and some really good communication back and forth. And even in the meetings, they last anywhere from typically around an hour and a half, and there's also some really good discussions. I'm looking to potentially have other people on the meetings, meaning I might have a representative from Fidelity or from Schwab related to Thinkorswim. So that's something I'm looking at doing too, so we can have like guest hosts where it's not just me or it's not just the membership, but we have a guest that comes on and shares what potentially might be happening. So just something to keep in mind. Next, a big move or a big change that's helped me dramatically is being strategic around earnings, understanding that earnings can have a huge impact. So one, it's avoiding expirations right around earnings. So trying not to expire like a day or two before or a day after earnings, or a day or two after earnings. Typically, though, most earnings, the expiration you're going to be dealing with is on a Friday, and earnings could be any time during that week, unless it's after hours on Friday, which also happens. So by avoiding expirations where I'm not allowing something to expire right around earnings, has saved me a lot of problems I had in the past with certain trades. So something to keep in mind. Now, on the flip side of that, if you use earnings again strategically, when a great company misses earnings, it's a great buying opportunity. So you can potentially pick up a name at a really good price and pick up some premium along the way, again, improving the price you might get assigned at. And that can especially work well if you're running the wheel, because you can potentially be selling cash secured puts right near the value of that stock, especially if it's dropped 10, 15%. I like to go out and look at charts like 10 years out so I can get a real feel for where a company stands. Is it undervalued or overvalued? And if it's undervalued, then I'm okay with writing a cash secured put a lot closer to the money. So just something to keep in mind. It's something I should have thought about a lot more. But at first, I didn't really care about earnings. I just kind of would pick expirations. I would look at a strike, and I would not look at earnings. And now another one is also the ex-dividend date. You do need to keep that in mind and try to also avoid expirations right around those ex-dividend dates. Or the main impact is, when a company makes that ex-dividend date, or you're at that ex-dividend date, the stock typically drops the price of the dividend in most cases. So a lot of people, because they want that dividend, can go ahead and initiate assignment if it's in the money or near in the money, because again, they primarily want that dividend. So just something to keep in mind. And then next is to align risk with your comfort level. Now, this is something that I don't think enough people talk about. You don't have to trade like everyone else. I have a lot of members that join and they're like, well, what are you making? Can I make what you're making? And I always have to share with them, I've been trading for a number of years, but set goals for yourself. It's kind of a journey. It's a learning experience. As you learn more, you become a better trader. You kind of learn the ins and outs. So some people might be willing to take a lot more risk. I'm very risk averse. I do have some members that are willing to take a lot more risk than myself. I actually have created some Discord channels where they're kind of higher risk channels where they'll share their trades there, just so that people know that these are much higher risk trades. They may be doing trades on Bitcoin or actually doing options on Bitcoins or some of the new Bitcoin exchanges or ETFs. So just something to keep in mind. You don't necessarily have to take as much risk. I know of other people and other members who, they only do 10 deltas, and, they are just trying to add 2-3% or 4% a year versus trying to do like 1 or 2% a month. They just want to be a little bit more comfortable in their retirement. So they prefer to take a lot less risk. So you can define that. You can define that through your delta, through your strikes. Of course, if you go farther out, and this is typically the case, the farther out you go, meaning if you're doing a 60 DTE, it's safer and easier to work with than, say, a 30. And a 30 is easier and safer to work with than a weekly. And a weekly is safer and easier to work with than a daily, and so on and so on. Like zero DTEs are very complex. You have to know a lot of the ins and outs about the market. You need to know what the market makers are doing, what the hedge funds are doing. So just something to keep in mind. So I do have people who are doing zero DTEs. I have people who are, going out 60 days because they prefer, not only that because it's safer and easier to trade, by going farther out, you can pick lower strike prices. So if a stock is $80, you can maybe pick 70. Whereas if you only did a monthly expiration, you would have to go half the difference potentially. So instead of $10, it might have to be $5. So, and I believe everybody should define their own risk. What works for them won't necessarily work for the next person. And if you're like myself and I'm 59, quickly approaching 59 and a half, I don't have a long time to make mistakes. But some of the younger guys or gals, they have 30, 40 years and they can recover from some mistakes. So they're more willing to take higher risks. So just something I wanted to mention. Now, next is just a bonus I wanted to share in this video. I'm going to share my planning worksheet, some changes I've made, and what's kind of in it to help me for setting my goals and, trying to become a better trader. So stay tuned. Let's jump into that next section. This is my current planning worksheet for this month. The first tab has all my different trades. I color code things. I also show if a particular trade is in the money, out of the money. I also keep track of how much required capital you might need, what the delta is, how much, assignment cash or money you might need if it's assigned to you and you have to manage it. So, and I pretty much have all my trades in this one particular planning worksheet. I'm not going to go into particular trades. I'll do that in future videos, but this is always the first tab. Then the second tab is my favorites. This is what I share with my membership. I update the prices. I'll pull companies off this list. I'll add new companies to the list. I color code it. Yellow means I like the companies, but they're too pricey. No color code. They're again, I won't put anybody on here that I don't like, but pricing does matter. So like AMD has been hit hard recently. It's not so overpriced as it used to be at one time. But Square is fairly pricey. It's come down. So I also provide this typically on a Sunday in the morning, and I try to update it. I used to fill out all the other information here, but I found that the market by Monday had radically changed. So I just have a description why I like the company, the symbol, the type, and then what the current price is. So if I think it would be good for a vertical put credit spread or something along those lines. And then I just also have some other core information. Now here is my trade rankings. I have two purposes for this page. One is to dig deeper. Why did some of these trades go against me? This is a list of all the ones that have, like here's Lumen that I was talking about before, too much debt and also poor management. And then Big, they had supply issues during COVID and just never really recovered from it. So I identify that. And then the ones that are in green are where they were assigned and it worked out okay. Like ARC was assigned to me long time ago after it went through a rough spot, but now it's recovered and it's profitable. Same thing with Dell and UPS and Airbnb. So this is something that I believe it makes me a better trader by reviewing what have I done wrong or could I have done differently. Like one interesting thought process is potentially trading more in ETFs. Now I don't find as much volume or premium in ETFs, but I've hardly had any ever get assigned to me. I've had a few get assigned away from me, but very few have ever been assigned to me through puts. I think only one over the last 2 or 3 years. And I write quite a few. Now, they've gotten pretty pricey recently, but I noticed they're coming down, like XLE. I came close to writing a trade on it today. So this page has helped me, and these are all the different criteria I like to look at. Then I have a checklist. This is also a checklist for selecting securities. Again, what I like to look at in some details. And then I have my guidelines. These are for selling options, for selling covered calls, for selling puts. You know, what kind of deltas I like to use for ETFs versus regular stocks. And it's different for puts versus calls, which that may change because again, I'm finding that recently with the calls going or with the stocks going through the roof, a lot of my calls are in the money. So they become a little bit harder to manage. And I've had one or two get assigned away from me recently, but they were all profitable. One of the big lessons to learn when you trade calls is be sure you always do it above your cost basis. And, you know, so details here, I also talk about what's worked, what hasn't worked, you know, what kind of expirations, and also a little bit about earnings. And then I love this saying, pigs get fat and hogs get slaughtered. You know, it's not getting rich quick. It's if you can double your return, you know, you can go from a six to a 12%. You're going to be doubling your money every 3 to 4 years or 5 years. Or if, you know, you can go from a 12 to 18%, you're going to be increasing your, you know, compounding so much that if you've got a long time until retirement, it'll grow your money so much quicker or grow your portfolio so much quicker. So something to keep in mind. And in goals, this is my different goals. So I talk about, you know, how much I want to earn during Social Security. And, you know, this includes options, premium, and dividends. And I also do videos on this. But I started tracking this. It was hard to track when I was moving my funds from Schwab over to Fidelity, but now I've been keeping track of it. And typically when you see the red is my goal is 7,000. So the blue is I've been able to do above 7,000 and I was still able to do 4,900 even though I had quite a few stocks get assigned to me back in May. Now in November, I also had ACLS get assigned to me. I still have the puts and the puts themselves are still worth $20. So, you know, I haven't made a decision on that one yet because I'm still trying to decide potentially will ACLS regroup and you know, it's interesting to see that they're not doing well, but Tesla's hit a new all-time high and ACLS makes a lot of the EV market chips and their chips are becoming, they use less energy and they're just well-made chips. So something I'm still trying to decide, but I keep details and I like to see, you know, what was assigned when, and then I also have notes about goals. And then I also have some information here about previous year results. And then this is kind of a continuing process and I share it again with my memberships. Some people choose to use it, others do not. I do know a lot of them do use the guidelines and the checklists, and we also talk about the planning worksheet and making changes. I've had a lot of members suggest changes, like the radar column was probably the latest change. And then I've also, some of these changes over here were due to members, this assignment coverage. Do you have enough cash to cover an assignment? You know, and even yearly ROI has been in some interesting discussions. You know, I primarily try to look at the ROI so I can compare similar types of strategies. So you can't really compare a vertical put credit spread with a cash secured put, mainly because, you know, by having that put, you're limiting or you're not needing as much required capital. So of course your return is going to be higher. but it allows me to compare two vertical put credit spreads side by side to get a feel for how each of them is doing, and could one potentially be a lot better. Like, I've been able to do this comparing stocks with ETFs, and that's where I've identified that stocks do have higher premium typically, but the ETFs are so much safer. So there is an argument to just stick to ETFs and not ever, do individual stocks. And I've had some dogs like Walgreens. I took a big loss. Luckily, it was in my taxable account, but I took a big loss against my other gains. But I would rather have not invested in Walgreens than to have what happened. So this is what I wanted to share with you guys. Hopefully, I didn't get too wordy. Let me know what you think. How do what are the big moves or strategies that you take that has helped you become a better trader? So I typically try to get to almost all my comments within the first 24 hours. So please leave a comment, and I'll respond to it. It'd be nice to have a little bit of a discussion. So thank you for joining me and taking the time to watch the video, and I look forward to seeing you next time.